So the first one is federal loans. So the federal ones are going to be your safest. They have a set interest rate, which means it doesn't go up when the market changes. It also doesn't go down either, but there's a set interest rate and you kind of know exactly how much you're going to borrow and what the repayment is going to look like. So there's two types of federal loans. There's subsidized and unsubsidized. So what is the difference? A subsidized loan is a loan that the government pays the interest while you're in school. So if you borrow $5,000 at the end of 4 years, you actually only owe $5,000. You didn't accrue any interest while you were in school because the government subsidized. Remember, subsidized is to cover that amount in your interest. Now, you also have unsubsidized loans. So unsubsidized loans are ones that the government gives you that they don't cover the interest. So sometimes you'll get both. And it'll say federal loan subsidized, federal loan unsubsidized. So unsubsidized means that during the time you're in school, you'll actually have to pay the interest during that time. So if you borrow $5,000 and you have an interest rate, maybe by the time you graduate, your loan is now $5,500 after 4 years. No matter what, once you graduate, both subsidized and unsubsidized loans now are going to have interest. It just determines whether or not the interest will be covered by the government while you're in school. The other really good thing about federal loans is that you have the possibility of loan forgiveness. Right now, we're all talking about loan forgiveness. Are we going to get it through the government? There's also programs like the public service loan forgiveness program. There's programs if you decide to be an educator or a doctor in a nonprofit place, and they might forgive your loans. The only ones that usually qualify for that are going to be your federal loans, right? And so you just want to make sure that you go first with the federal loans. Now, if there's still a balance, you might have to consider private loans. Private loans will be offered to you by universities. A lot of times they have a relationship with a bank because private loans are going to come from a bank. And so the interest rate for these loans are going to fluctuate. Depending on the market, will depend on the fluctuation of the loan. Now, there might be some private loans that have a fixed interest rate as well, and that's an option too. But just know that a lot of them are going to have interest rate changes. And for most of you, if you're starting out and you're 18, you probably are going to need a cosigner. And this cosigner is going to need good credit. So depending on your family's situation or access to like other family friends who might be willing to cosign with you, they may or may not want to be a cosigner for a student loan. Because ultimately, if you choose not to pay that loan, they're on the hook. It's going to be on their credit report. And people can go after them to get their money back because they're deciding to co-sign the loan with you. So don't be alarmed if someone says, no, I can't do it, or no, my credit isn't that great. We're going to talk a little bit about how to approach these conversations with our families, but I just want you to know that private loans are the next option that might be presented to you. The third option is going to be a Parent Plus loan. So this is a loan that a parent can take out on behalf of you to go to school. Now, of course, they're not obligated to do this. If they do it, you should be very grateful. But it also, you have to remember that it is based on the parent's credit. So depending on their credit will depend if they actually qualify for the loan and how much of the loan. So after you take out your federal loans and you decide to get financial aid, once you see all of that, you might have a balance of $20,000. Depending on how much your parents have, they might not get approved for $20,000. So it still might mean you don't have enough to go to that school. Because one thing you have to remember about the Parent Plus loan is that the payments begin immediately. For you, your payments don't begin until 6 months after you stop going to school. So 6 months after you stop going to school can mean one or two things. One, you decide not to take classes, and so you kind of like stop out of school. You decide that you no longer want to go, or it can mean that you graduate. But for your parents, they're going to begin immediately, within about 45 days. So thinking about your own home situation, how much are they already spending? Whose mouths do they have to feed? What housing and other expenses do they already have? Will they have enough to pay an extra $500 or $600 for you to go to school? But these are your loan options. And you're going to talk a little bit with your family a little bit after, and I'm going to give you some guidance. But these are the things that you need to know. Loans have to be repaid unless you qualify for some sort of loan forgiveness. And even then, they still need to be repaid. So I qualify for the public service loan forgiveness because I've worked in education. And so I did qualify for that particular loan forgiveness program. However, I still paid my loans for 10 years. Right. And so I'm still going through that process of waiting for the forgiveness. I think I have maybe about 10 or 11 more months left, but I'm still paying an amount per month. Right. So just because you qualify for loan forgiveness doesn't mean that your loan payments are zero.